Welcome back to Investing Talk Podcast.
Today we're looking at Applied Digital.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. With Applied Digital, the whole story, the core investment thesis has just fundamentally changed.
And it really has. It feels like the market's perception is lagging behind the reality.
Exactly. It's moved from being a speculative idea about the future into a story about present execution. It's all backed by real contracts now.
Okay, so let's unpack that shift, because that's really the heart of it. We're not talking about a construction company anymore, just hoping to land a deal.
No, not at all. We're talking about an operational company that is actively generating revenue. They've pivoted completely to high-performance computing data centers.
And these aren't just any data centers. They're purpose-built for really intense AI workloads.
That's the key. The pivot from building something hopefully useful to building something that is already sold. And the proof is it's staggering. It's the $16 billion contracted revenue backlog.
$16 billion. I mean, you hear a number like that and you have to take a step back.
You do.
For a company of this size, what does that even mean? It totally changes the game. It almost feels less like a tech stock and more like an infrastructure play. A REIT, almost.
And that's a perfect way to put it. The number itself is shocking, but it's the certainty that it provides. I mean, you've got 15 years of revenue visibility. It's almost unheard of.
And you have to ask, who's on the other side of those contracts?
Right, the counterparty risk. And that's the beauty of it. This isn't Joe's AI startup. These are investment-grade hyperscalers.
So we're talking about Microsoft, Amazon, Meta.
The most stable companies in the world. When they sign a 15-year lease, the entire investment is it's incredibly de-risked. It's almost like holding a long-term bond that's backed by the entire AI industry.
Okay, so with that certainty, what does the financial roadmap look like? The growth must be pretty explosive.
It's not just linear growth. It's a true parabolic curve that's about to hit. It's waiting for those data centers to come fully online.
Let's put some numbers on that for everyone listening. For fiscal 2026, so the current year, revenue is projected to be somewhere between, 280 and 297 million.
A solid 30 to 38% growth, which is great.
Very respectable.
But then you look at fiscal 2027, and that's when the hockey stick really turns vertical.
Okay.
The projection just jumps to between $541 and $553 million. That's, 86 to 93% growth in 1 year.
Wow. And that's just a direct result of those contracts finally moving from a construction line item to an operational revenue line.
That's it, exactly.
Now, this brings us to the big question for anyone just glancing at the filings. Profitability. Because right now, the P&L, it shows an operating loss.
It does, and we have to be really clear about this. Analysts are calling this a temporary accounting artifact.
Okay, what does that actually mean?
It means that when you're in a huge capital-heavy build-out like this, your income statement gets hit with all the construction depreciation and the interest costs on the debt.
So all the costs hit the books immediately.
Right. Before the revenue from those 15-year leases has had a chance to really ramp up and cover them, it's a paper loss, not a reflection of the asset's health.
It's an intentional spend. So for you, listening to this, you have to look past the current income statement and see the trajectory.
And you can see it already. The EPS, earnings per share, it's expected to improve massively from negative 80 cents in fiscal 25 to negative 31 cents in 26.
Okay, so it's moving in the right direction, but when does it cross the line?
Fiscal 2027, that's the inflection point. That's when positive EPS is projected to finally hit, around 15 cents. And that's the moment it truly turns into a high-margin recurring revenue business.
And a long-term potential here, given the leverage in the model, it's huge.
Yeah.
We're talking about a potential for $500 million or more in annual net operating income.
Or NOI. And that could easily scale toward $1 billion within 5 years once they really max out their power allocations. And NOI is really the metric to watch here.
Right, because it strips out all the financing noise and just shows you how profitable the actual assets are.
It's the pure operational health.
So if the financials are that strong and backed by $16 billion in contracts, the next question is the moat. What stops a competitor from just copying this model?
And the moat it's deep. It's multi-layered. It's built on both technology and resource scarcity. So layer one is their proprietary cooling.
I saw a figure on this that was just kind of mind-boggling. Their liquid cooling is something like 3,000 times more efficient than traditional air cooling.
Yeah. 3,000 times. And you have to understand, that's not just a nice tech spec. It is a fundamental structural cost advantage. Better efficiency means way lower energy costs per computation. It means lower maintenance. It means they can offer competitive pricing and still maintain higher margins than anyone using old air cooling tech. They have a pricing floor that others just can't touch.
And they can guarantee performance for the GPUs, which the hyperscalers absolutely demand. Okay, so that's the tech moat. What's the geographic one?
That's layer 2, and it might be even more important. They've secured exclusive access to gigawatt-scale, low-cost power, and they've done it in North Dakota.
Which is key because
Because North Dakota is rich in energy, but crucially, the grid isn't overutilized. For you listening, we're seeing all these stories about power bottlenecks in places like Northern Virginia.
the grids there are completely maxed out. They literally can't supply enough power for all the new AI data centers.
Exactly. Power is now the scarcest resource in the entire AI race. So by locking up huge amounts of cheap power in an underutilized grid, Applied Digital has built a geographic moat that is almost impossible to replicate right now.
They bought the land and they bought the power. And they've also dealt with the other big risk, which is the capital to actually build all this.
Yes, they've been very smart about de-risking the capital structure. It's not just debt. They have major financing backed by Macquarie and this is the real validator.
Yeah.
Capital commitments directly from NVIDIA.
Getting NVIDIA's money is a massive vote of confidence.
It is. It basically eliminates any near-term capital constraints. It says the world's most important chip maker believes they can execute.
Okay, so the long-term picture is solid. What about near-term catalysts? What's going to make the market wake up to this?
The big one everyone is watching is the Q2 fiscal 2026 earnings report. That's scheduled for January 7th, 2026.
And that's the moment the operational reality finally hits the income statement in a big way.
That's the inflection point. The consensus right now is for about $82.22 million in revenue that quarter. If they hit that or beat it, especially with strong guidance, that could be the trigger.
And on top of that, there's the Chronoscale spinoff.
Yes, this is a huge deal. They're spinning off their cloud computing business, merging it with Exobionics, and creating a new public company called Chronoscale.
Now, hold on. To some people, that might sound like they're getting rid of the exciting high-growth part of the business. Why do that?
That's a great question, and it gets to the core of the value unlock. Analysts see this as a really smart move by letting Chronoscale be its own thing.
It can grow faster.
It can grow faster, and it can attract a pure-play tech valuation multiple. It's not weighed down by the parent company's capital needs for building data centers.
And that leaves the parent company, Applied Digital, as a pure infrastructure play.
Exactly. It becomes a much simpler story for investors. A stable, high-margin landlord for hyperscalers. It's about splitting the company so each part can get its own optimal valuation. Two great businesses instead of one complex one.
And the market is already showing confidence. The stock was up, 237% last year? A really strong uptrend.
A very strong uptrend. And that, combined with the fundamentals, has created an interesting setup. You've got pretty high short interest on the stock.
Oh.
Yeah. So when you have high short interest plus a major potential catalyst like the January 7th earnings, that's the classic recipe for a potential short squeeze.
Let's talk valuation then, because there's a real disconnect here. The company's market cap is sitting around $6.7 billion.
And that's the paradox. A $6.7 billion market cap against a $16 billion contracted revenue backlog. The market is still, sort of pricing it like a speculative tech stock.
Not like a contracted infrastructure landlord.
It hasn't applied that multiple yet.
Yeah.
And that potential re-rating is where the upside comes from. It's why, of the 10 analysts covering the stock, 100% of them have buy recommendations.
What are they targeting?
The median price target is around $42.50, but some go as high as $56. From recent levels, that's anywhere from, say, 49 to almost 100% upside.
Okay, but we have to cover the bear case. What are the biggest risks?
Number one is always going to be execution risk.
Delays in the build-out.
Exactly. Building these things is complicated. Any significant delays in construction or power hookups could push that profitability inflection point further out.
But that feels pretty well mitigated by the financing from NVIDIA and Macquarie.
It is. The capital is there. And the leases are for 15 years, so a few months delay doesn't change the long-term revenue picture.
What's the second risk?
Valuation sensitivity. Look, the stock trades at a high multiple, around 30 times sales. If there's a big market downturn or a a sudden panic about AI spending.
It could get hit.
It could.
Yeah.
But again, you come back to the $16 billion backlog. A major correction really only makes sense if you think that AI demand is going to completely collapse, which seems, well, extremely unlikely right now.
I did see one minor point about some local community concerns in North Dakota, something about truck traffic.
Yeah, that's a local operational thing. Management is aware of it, they're working on it, but you have to keep it in perspective. It's not something that's going to impact the core financial thesis here. It's not a deal breaker. So to just circle back and bring it all together for you, the whole bull case for Applied Digital has shifted. It's not about what if anymore, it's about what is. It's present execution backed by real funding and massive contracts with the biggest companies on Earth. You have the January 7th earnings inflection coming up, plus the Chronoscale spinoff unlocking value. It just looks like a really high conviction way to play the multi-year AI infrastructure build out.
That structural shift really is the key takeaway. But for me, the real test, the ultimate proof, won't just be that first positive EPS number. It's going to be watching the free cash flow, watching it flip from this deeply negative number because they're investing so heavily to positive as those high margin leases really kick in. That's when you'll know the growth thesis is mature, and this company has cemented its place the premier landlord for AI.
Make sure you subscribe to the podcast so you don't miss our next analysis.